Hello everyone, my name is Moji. You're watching a Bitcoin Bubble News channel. Okay, I think most of you have seen the Bitcoin price chart that is written in linear form. Many people do it on Bitcoin Twitter and other places as well. They show all the highs and lows. That picture has not been seen by most people in the world. These people usually look at the straight chart, which at any given time either shows a crazy bubble or a broken bubble. And that's how most people see it. The wall isn't going to sell. There are still only a few new apples coming into the space right now, but a lot of those coins have already been turned over to the diamond hands and away from the fast money. Because of that, I think we'll still be going through that cycle for another 12 to 24 months. Lyn Alden starts by talking about the Bitcoin price chart in logarithmic form, which is well known in the Bitcoin world but not so much outside of it. When looking at a linear chart, most people only see the patterns they have seen firsthand. For many, Bitcoin either looks like a crazy bubble or a broken bubble. Based on when they look at it, they often don't see that Bitcoin has shown a trend of higher highs and higher lows over many cycles. Alden says that every new high and low makes Bitcoin stronger and lasts longer. A lot of people have only seen 2 or 3 big cycles, but the longer Bitcoin stays strong, the harder it is to ignore. She says that the third major turn is especially important for proving Bitcoin's reliability. Alden talks a lot about how important long-term holders, also known as diamond hands, are to the Bitcoin environment. In bull markets, some long-term buyers may sell to take the money they've made. In bear markets, on the other hand, the coins get stronger over time, making people less likely to sell. As a result of this change, there is less supply available, and even a small rise in demand can produce big price changes. Take a moment to like this video, subscribe to the channel, and set your alerts to receive more videos like this. You can also watch our other movies about cryptocurrencies and digital assets in general. Let us know what you think in the comments below. For the channel's growth, everything you do is very helpful for the YouTube system. Thanks and have fun with the movie. While most people have only seen the cycles they have personally seen, that is what most people have seen. Their standard view of the linear chart is that it either looks like a crazy bubble or a broken bubble at any given time. That's how most people see it. In general, they don't see those older rounds because of this. At this point, they may have seen the bull market run of 2017 or 2020, and those 2 cycles are really all they've had. They know Bitcoin has been around longer than that, but the price chart doesn't really stick out in their minds. And I think what keeps people interested is that every new high, every new low, every new high, and every new low is like another sign to them that Bitcoin is still alive. So they don't see the 4 or more rounds, they only see 2 or 3. I also think the third one is pretty important. If you see something not die 3 times, it's hard to dismiss it. I think we're having some talks with institutions at the institutional level, and I think those are going a lot better than they did a few years ago. I believe that problems show up at different times in each cycle, and things are made in reaction to those problems. To kind of look ahead and see what problems will be there is one thing. That's something that people always try to do. But they don't really look for the answer until they need it. In this case, people don't really pay attention to other stages when fees are high or low in the main chain. When fees are high on the main chain, though, those levels become important to them. And all of a sudden, more people are ready to build layers because there's a clearer need for them. I think there will be some rough spots along the way. Fees are likely to be one of the most noticeable ones during manias or when people add other things to the chain for a variety of reasons. I think that's one reason why there will be a shortage and a reaction to it. I agree with what you said. The hotel wave, like the 70% of coins that haven't moved in a year, might have just as big of an effect as the half that happens every cycle. Also, for those who don't know, when Bitcoin is going through a huge bull market, some older coins that haven't moved in a while start to be bought and sold. People have made 5 times or 10 times or more what they put in. A few people cut their jobs or need to save money for a down payment on a house. As the price goes up, money starts to be sold. At some point, that will have met all the new demand that's coming in for the cycle, along with all the other meme coins that are kind of taking up the extra demand. During a bear market, however, a lot of the quick money leaves the market. Over the course of a year, 2 or 3 years, more and more of those coins end up in hands that aren't likely to sell anytime soon. They are either in MicroStrategy, which means they will never be sold, or they are held by different people for 5 or 10 years. They don't have any plans to sell soon. After that, it only takes a tiny bit of new desire to break through that wall of not going to sell. We are now seeing that even though a small amount of new money is coming into the space, a lot of those coins have already moved to the diamond hands and away from the fast money. I believe that's still a cycle we'll have to go through for another 12 to 24 months. People are what institutions are made of. In our language, we often talk about people and organizations as two separate groups. Institutions, on the other hand, are just groups of people who work together. And when you talk to people in organizations, you'll find that a lot of them do get it. A lot of them own Bitcoin on their own, and some of them are even CEOs. It hasn't quite reached the point where they can bring it into their school yet, though. It wasn't on their big balance sheet. They couldn't include Bitcoin in their company balance sheet, their pension balance sheet, or their asset allocation plan, even though they own Bitcoin. I just can't give it to my clients or put it in the company's bank account yet. As the asset goes through more good times and more milestones are reached, they can start to bring that from their personal account and do some of the same things they've already done in their personal life, but in their professional life. This is because the asset has grown big enough, become liquid enough, and been understood enough for them to bring it to their peers. Alden talks about Bitcoin's possibilities. To the way institutions use standard assets like Apple stock, big banks are ready to lend a lot of money against assets that have been around for a while. As soon as banks can store Bitcoin, they will probably start to offer loans and other financial services based on it, since it is less risky than many of the other assets they handle. She says that the main thing stopping the growth of Bitcoin credit markets is that big banks can't store Bitcoin. But once this problem is fixed, giving credit will be the next logical step. The fact that businesses like Unchained, which offer Bitcoin-backed loans, are doing well shows that this market can work. These companies handle risk by keeping property safe and providing low loan-to-value ratios, which keeps things stable even when the market changes. I have $1 billion worth of Apple stock. Over the weekend, a big bank would lend you $100 million against that stock. If you owned $300 million worth of Apple stock, they would lend you an extra $100 million over the weekend. There's a chance that China will say Apple can't make iPhones, which would cause Apple stock to drop in the morning. You didn't take the risk, the bank did. The bank is also going to take the 48-hour or 72-hour settlement risk on all of these other assets. If they used Bitcoin, they would be taking a lot less risk. Bitcoin makes the bank less risky, but that's not really the point. Banks are already taking on more risk, and they're fine with it, and their bank sheets are huge. The amount of equity cash they have is hundreds of billions of dollars. The main point is that the only thing stopping Bitcoin credit markets is the fact that only large banks can store Bitcoin. From there, it will only make sense for them to start lending money once they start keeping Bitcoin. They don't have to deal with any problems because of the type of assets. Giving credit is a better tool for them. It's better than the $100 trillion fair value. It's not worse. So I think they will accept it, and they would see it as a lot less risky. It's much easier to handle, not because there's a problem with Bitcoin, but because they have other things to do. There's just no way for them to keep it. It's out of their hands if they can't keep it. That's why that market isn't going to blow up. I think things have gone well, for instance. There are Bitcoin-backed loan companies like Unchained that have been around for a long time.